Hello, everybody. Luke Gromen, FFTT. Hope you are well. Hope you had a great weekend. Let me jump right into some of the questions. Appreciate everybody who submitted a question. First question is from WW. Can both the dollar wrecking ball and de-dollarization theories be simultaneously correct? I think it's a great question. It raises a critical point, and the answer is absolutely. In fact, it's really what I've been trying to describe a lot of the time. I think it's poorly understood that they can both run parallel and can really reflexively back and forth reinforce each other at various times. So what I mean by that, de-dollarization of commodities actually drives the dollar up, and the dollar being driven up drives increased incentive to de-dollarize commodities. And so the easiest way to explain this, let's assume that all oil globally tomorrow goes to Chinese yuan, no more dollars. And we'll do this because extremes inform the means, right? So all oil globally shifts to yuan overnight. So the oil market is globally, let's say, $2.5 trillion for round numbers. So a $2.5 trillion annual trade shifting out of dollars into yuan overnight. So we know that based on the dollar's incumbent status as global reserve currency, euro dollar market, global dollar debt, there's a huge dollar bid outstanding, just incipient for interest payments, debt service. Okay. So if you take $2.6 trillion in oil market liquidity annually and shift it away from dollars into yuan, you're going to take away dollar liquidity to serve that debt. Fewer dollar supplies, consistent dollar bid, dollar up. At the same time, there is very little global demand for yuan, little yuan debt. China's not been running deficits. No euro yuan system. You're going to take 2.6 trillion in yuan or liquidity and shove it into yuan via oil almost overnight. What's going to happen? A lot more supply of yuan, not a lot of demand for yuan. Yuan down. So you can see de-dollarization of commodities from that angle, even on smaller amounts, all else equal, is going to put upward pressure on the dollar. Now, if the dollar rises of its own accord, Fed hikes rates, Yellen cuts liquidity by raising funds in the TGA. Dollar up, and we're seeing this live as we speak. Ghana just did it. China's been trying to do it and having some success doing it, which is dollar up puts pressure on the current accounts of all of these emerging markets around the world. And so that is going to incentivize them to buy energy in their own currency if they can, buy commodities in their own currency if they can, because that then frees up dollar liquidity for them to service existing dollar commitments, dollar debt. So you can see how reflexively one can cause the other, one can reinforce the other, but can they be simultaneously correct? Absolutely. And that's, I keep saying, is if we strengthen the dollar too much, you're going to force a choice between completely de-dollarize oil or let your economy collapse for lack of oil because they run out of dollars. It's no choice. They are going to de-dollarize oil. They will come up with other arrangements. We have seen that in the last year with the other arrangement Russia has made. Russia's currency was supposed to hyperinflate. The ruble was supposed to be ruble. Instead, it was the best performing currency last year. Other arrangements will be made. The top of the stack is not the dollar. The top of the stack is energy. Okay, second question. Sam, in your Tree Rings newsletter, you wrote that you think Treasury is actively working to weaken the dollar. What tools do they have to do this? You've probably seen people talk about the Treasury General Account, TGA. That had been run down. It's actually being run back up a little bit in recent week or two. But it was run down sharply in the fourth quarter. That injects dollar liquidity into markets, all else equal. I think there was also some coordination between Janet Yellen and foreign allies of the United States to try to manage the dollar down via monetary policy. You can see that when the Bank of Japan widened yield curve control, when the ECB got more aggressive with rate hikes, all else equal, that helped weaken the dollar. The other wild card in all this that is very difficult to know is something called the Exchange Stabilization Fund, or ESF, which is the Secretary of the Treasury can use with the approval of the president. Really no other oversight as I understand it, but I was looking at it recently. I didn't realize this. From 2013 to 2019, the assets in the ESF were around $90 billion, between $90 and $100 billion, which is pretty significant, can be used to manage relative currency rates, maintain stability in currency markets, which is what, and gold markets too, by the way, which is what it is to be used for. In 2020, that $90 to $100 billion asset base was flexed up to $676 billion at year end. That number came down to $232 billion by the end of 2021. No update yet in their year-end balance sheet updates. Obviously, that was to help manage through COVID and market stability. But that gives you a sense. I was shocked. $676 billion is still a whole lot of money, even these days with the numbers getting a lot bigger. So could the Exchange Stabilization Fund be used to achieve policy goals for the Treasury to get the dollar down? That's what its mandate specifically says. Are they doing that? I don't know. It's not anything you can track on a real-time basis that I'm aware of. So those are some of the things they could do. From SB, can you comment on the reported Russian gold sale of 3.6 tons of gold out of their wealth fund? They ran a budget deficit. They're spending a lot of money on the war. Apparently still running a current account surplus. So to me, it's unclear why there must be a liquidity mismatch is one explanation. So they sold some gold. 3.6 tons is, I don't know. It's probably $200 million, $150 million. I want to say it's $50, $60 million a ton off the top of my head. Relative to the 1,800 tons they have officially, it's not that much. It's interesting, but it's not particularly noteworthy. Could just be a cash flow issue again because they're running a current account surplus. They're still okay. To me, the more interesting question is in light of what Zoltan Pozsar wrote about a month ago, 2 months ago, I guess now, and more importantly, what Putin economic advisor Sergei Glaziev said about 3 weeks ago in Russian language media that was picked up by nobody here, by and large, in the mainstream media, which was referencing Zoltan's work, saying, "Listen, we should revalue gold for trade." Using specifically the example going from 1 barrel per gram of gold, roughly where it trades now, to 2 barrels. Per gram of gold. We can use our oil to revalue gold as a reserve asset. So, point being is the question is, okay, was it a cash flow issue? They're burning down to fill in a budget deficit. Was it a cash flow issue because they're still running a current account surplus, so they shouldn't need the cash on a full run basis yet? And then the second question is it possible that this gold was sold and received above market proceeds in return in some sort of trial run for what Glaziev was talking about? Who knows? We'll see soon enough. But there's not enough information on the surface. You know, the Occam's razor explanation is a cash flow issue with the budget deficit. Not enough information to know beyond that. From MD, hey Luke, do you think that where we have our cash positions will matter in coming years? Banks, brokerage accounts, T-bills, etc. Will solvency come into play? In my opinion, no. If you're in a position to, if you have the uptown problem of having more than $250,000 in cash, for me, I would hedge that by staying under the FDIC limits. That's $250,000. Anything under that, I don't know that it matters a whole lot. I'm not worried about solvency type issues that would come into play. But that if you do have more than $250,000 in cash, I do think that is possibly something to think about in the early days of a crisis were it to occur. You don't want to wait long at that point. So that's how I would think about that if it was me. From JG, how do we best protect ourselves financially for the coming years? Thank you for your insight. Thank you for joining. For me, it's about balance. Balance and low leverage would be the two things I would highlight. And so, look, we're in the first bursting sovereign debt bubble globally in 100 years. We're at the end of a 50-year currency system, and that's not the end of the dollar reserve currency, to be clear. That is a change in the structure of the dollar's reserve system that we're watching unfold. When you see the U.S. bringing semiconductor fabs back to the U.S., that is a complete reversal of the way the system has worked since 71. That is the early days of a change in the structure of the dollar system. Don't let anybody tell you otherwise. We're in peak cheap energy and commodities. And you've got hundreds of trillions or more in notional value and derivatives. So no one's ever lived through anything like this before. I don't know how this is going to play out. I think anybody who says they know how it's going to play out, it's going to be really tough to tell. The range of outcomes go from extremely happy, positive outcome to really, really bad outcome. And the tails on this are fat. They are good chance it could work out fine. There's a good chance, or a fat tail chance it could come out fine. There's a fat tail chance it could be a real disaster. So in my opinion, when you talk about how do you protect yourself financially through these issues that are very unique historically, balance, low leverage, and then in my opinion, you have to start with yourself, okay? So you need to invest in your own health. If you're not healthy, you've got nothing. So that's where you start. Number two, your community. Have a community, family, friends, etc. Best investment. I think owning one's own small business, entrepreneurship, is arguably the best investment, however that looks for the person in question. Then beyond that point, I think you need, when you talk about balance, I think you need to protect against deflation, right? That's the dollar cash. That's this barbell approach we've been advocating. And then also protect against high inflation, gold, Bitcoin, energy-related commodities, EV-related commodities. Some hard assets that whether that's ideally that are under or non-leveraged and cash flow positive. Real estate that I would sort of prize real estate, things that is finite in some level, that can be rented out profitably. Still like infrastructure. So I think it's important within all of this to remember that sustained deflation is highly unlikely to occur. Because governments will default on their sovereign debt under sustained deflation, and no government with a printing press has really ever chooses to default on their debt. They usually print the money. So that's not to say you won't get these periods of deflation, but sustained deflation is very highly unlikely under the system we have. So that's how I think about it for myself. It's how I would advise someone to think about it. In terms of how to position for what are really pretty unique times historically. And then the final question is, from RC, do you think the U.S. government can/will manipulate initial claim stats as well? Will this bull market run end or be manipulated into a new bull market? There's a lot of people whose views I respect. I was just reading one today, Dr. Pippa Malmgren, highlighting that World War III has already started in some levels. Numerous other commentators I respect agree with that view. I think if that's right, it's going to be increasingly important for investors to take a very critical eye to every piece of government data that comes out, not just the U.S., Russia, China. Well, China you always have to take with a block of salt, but Europe. Every piece of government data will have to be looked at with an increasingly critical eye if we are indeed in sort of this new World War III, soft war, Cold War scenario. And I think it's important in that case to start thinking in terms of each government's motivations, because that will give you some idea how they want to color the data, right? So Russia needs oil and gas up, okay. The U.S. needs inflation down. They need oil and gas down, but they need oil and gas not down so much that it hurts shale. They need employment up, but they need the economy up. They need the EU needs energy down. They need inflation down. The U.S. wants gold down in a lot of times. Russia wants gold up. China needs growth up. They need food inflation down, especially food and energy inflation. So I think it's important, if we continue moving in the direction we seem to be moving, to understand and really take a critical eye, think critically, what am I reading? Why am I reading it now? What are the government in question's motivations? and then always be trying to find an indicator that is harder to be motivated. So for example, or harder to be manipulated. Physical oil supplies. There are inventories, there are paper derivatives, but at the end, it is a critically needed, low elasticity commodity with a very low stock to flow. In other words, there's not a lot of inventories to chew through. Shortages show up quickly. Excesses show up quickly. So that's, that is the kind of, I think Bitcoin is a read on liquidity that is one of the last functioning smoke detectors. That's another one. So I think it's increasingly important to watch these government releases from all governments as tensions continue to rise with a critical eye. It's not to say disbelieve at all, but just with an increasingly critical eye going forward, trying to match it or triangulate it with other data points that you can that you sort of can hold as your North Star in some way, shape, or form. So with that, I'm going to finish up for the night. As always, if you like these updates, please check us out, FFTT-LLC.com. Learn more information about both our institutional and mass market tree rings products, 10 most interesting things every week, brief synopsis about what grabbed our attention about them, and whether they're confirming, refuting a way we thought about the world before, or just simply catching our eye for being interesting. So thank you very much for joining me. I look forward to talking to you soon. Take care, everybody.